The Magnificent Seven having a magnificent day as we head into the heart of tech earnings. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Sonali Basak. We're kicking you off to the closing bell here in the United States, and everyone woke up and pressed the buy button, didn't they, Romaine?
They certainly did.
So let's talk about those markets. Let's get a check on where we stand. The S&P 500 up more than 1.2% on the day, near the highs of the session. The NASDAQ 100 also feeling the love, up even higher, 1.7%. And the likes of those semiconductor stocks, like NVIDIA, also feeling those gains. You have the Philadelphia Semiconductor Index up nearly 2.6% on the day. Even the bond market here getting a bid, Romaine. Of course, some softer economic data this morning, as well as a record auction in that 2-year.
Yeah, we're going to talk about that in a second, but let's talk about the Mag 7, 6 days of losses for that cohort here. Well, that's now giving way to back-to-back gains, the strongest 2-day surge right now for the group since the start of March. For the Mag 7 reporting this week, and as Pastanus once said, the stakes is high. Those 7 mega cap stocks making up 29% of the weighting in the S&P, 35% of the weighting of the NASDAQ 100. So as they go, so too goes the market. 5 of the 7 are projected to report double-digit percentage gains in earnings and in revenue, with Apple and Tesla the only outliers. Apple earnings still a week away, but Tesla set to post in just about an hour or so from now. Stay tuned, full coverage up ahead. Now, not everyone is sold on the rebound rally. JP Morgan strategist Marko Kolanovic says that while earnings may stabilize price action in the near term, he's actually concerned about complacency in some of those equity valuations. He posted a laundry list of reasons he sees softness ahead. That includes rising bond yields, elevated oil prices, high stock market concentration as well. Goldman Sachs tactical specialist Scott Rubner agrees, saying his bank's trading desk shows CTA momentum traders right now modeled to sell stocks over the next week, no matter which way the markets go. And here's one reason why. While forecasts for earnings growth point to continued economic strength, those pairwise stock correlations within the broader equity market, they started out the month of April at multi-year lows. And stock bond correlation, Sonali, they have been flirting with re-entering negative territory. That typically is a sign of more softness ahead.
I have some more signs for you, too. We're talking about those earnings expectations and just how much this quarter really matters, Romaine. Because when you look at the Magnificent Seven, the expectations for the first quarter alone, it is really expected to drive the S&P here to the tune of 38% EPS higher just for that Mag 7. That's even with profit, except this is soften over there over at Tesla. Now, if you look outside the Magnificent Seven, it's a much different story. Expected declines on the first quarter, but even with, Romaine, the Magnificent Seven here, you still have expected softening throughout the year. So it begs the question on whether the first quarter results are enough to lift this market higher for the year.
All right, one big pillar, of course, of the equity market, one big pillar of any potential gains remains earnings. But the float market also, of course, still focused on macro, still focused on monetary policy as all of those elements sort of mash up together today and over the next week and a half. Ash Alankar joining us right now, Global Head of Asset Allocation and Portfolio Manager at Janus, Henderson, to help us kick off to those closing bells. And Ash, I do want to start off on monetary policy and, more importantly, some of the inflation expectations, because before this earnings season started, that really was the narrative out there on Wall Street. And I know it takes a back seat, at least this week, but it's going to rear its head in a big way in just about a week's time.
Well, thanks for having me on. I think at this point in the cycle of monetary policy, it's important, if not essential, for us to ask the following question and reconcile the following facts. How can inflation drop from its peak of 9% in 2023 to about 3.5% today, yet the impact on economic growth, the impact on economic activity has been minimal at most? What are these so-called lagged effects? And this is despite the fact that the Fed has increased the cost of financing, has withdrawn the supply of money from the system at the fastest rate in nearly 4 decades. So why hasn't there been any consequences on the overall economy? And I believe the answer is quite simple. Monetary conditions have not been as tight as we think they are. At a Fed funds rate of 5.25%, if the neutral rate is 2.5%, which is the Fed's believed level of where economic growth and labor The strength of the labor market is not too cold. It's not too hot. It's just about right. That certainly tells you monetary conditions are very tight because it's a 300 basis point spread between the overnight interest rate and the neutral rate. But what if the neutral rate is much higher than 2.5%? What if it's closer to 5%? Then at a 5.25 Fed funds rate, monetary conditions are nowhere near being tight. The price of money, the cost of financing is nowhere near being expensive.
So Ash,
everything is about fair.
But Ash, if that is the case about fair, is there a consequence to that? Or are you basically describing, I guess, that kind of proverbial Goldilocks scenario?
So there's a big consequence to that. And the big consequence to that, which is relevant today, if monetary conditions aren't tight, it's going to be very, very difficult, for inflation to fall back to 2%. This 9% drop, or the drop of inflation from 9% to 3.5%, it likely had everything to do with supply coming back online and very little to do with monetary tightening, very little to do with the actions the Fed took to increase the price of money, to increase the cost of financing. So to get you back to 2%, the mantra has to switch to higher for longer.
Ash.
The mantra has to switch away from pivoting towards
Right.
accommodation anytime soon.
But what do you think about this neutral rate? Do you think that the reason it's drifting higher is in part because of growth, or do you think that growth might suffer? You look at some of the economic data weakening just this morning, and investors are shrugging it off, thinking that maybe we can get those rate cuts on the horizon. But people are not talking enough about this potential stagflation scenario. How would that read across?
Yeah, so why do I believe that the neutral rate is higher? It has everything to do with productivity. If you remember back to the 1990s, Greenspan believed the neutral rate here in the U.S. was closer to 5%. He believed the U.S. economy can handle a higher neutral rate because of the productivity boom from the personal computer, from the productivity enhancements, from the information revolution, the coming of the internet. Today, we might be sitting on a similar boom. First, the pandemic taught us a really important lesson on how to better use, how to better leverage existing technologies so companies and operations can move forward with more efficiency.
So, Ash,
we're on the heels.
If you believe in that productivity and efficiency, how do you feel about any potential for a downturn? That productivity is a bullish sentiment there, but if rates stay this high, how do you gauge the potential for things starting to weaken a little faster here?
That's a great question. If the neutral rate is actually closer to 5%, and Powell has praised Greenspan many times for that insight. If the neutral rate is closer to 5%, it tells you the economy can withstand interest rates greater than 5%. So the irony is, even though we have this mantra, and I think policy will start moving towards this mantra of higher for longer, a higher neutral rate implies a stronger economy. It then implies more robust growth, which then implies the markets and the economy are just fine in the medium to long run. The soft landing thesis is still intact as long as the Fed does not commit a policy error. And now I believe the policy error is more heightened than it was before because we're trying to peg to this nebulous number of the neutral rate. No one knows what the neutral rate is. It's a nebulous number. The best you can do is try to move into the direction of the correct neutral rate. But that's hard to do if you can't see it, if you can't touch it, if you can't feel it.
Yeah, not to mention that they almost seem like they don't want to even commit to providing some sort of outlook on that. That is going to be a big topic of conversation. And Ash, we have to have you back after the next Fed meeting to maybe get an update here on what they told us and maybe whether they'll acknowledge exactly where that neutral rate is. Ash Alankar over at Janus Henderson, helping us kick you off to the close here on this Tuesday afternoon. Coming up, a closer look at JetBlue shares down the most since the onset of the pandemic. We're going to get some insight into exactly why with Helene Becker over at TD Cowen.
Plus, Tesla on deck for one of their most important reports ever. We're going to speak with John Murphy of Bank of America Securities.
And there's a lot of folks really trying to suss out where this market goes next. Our next guest coming up a little bit later is Brent, Chief Investment Officer at Northwestern Mutual Wealth Management. He says investors are still looking in all the wrong places for all the right things. That conversation and more coming up in a bit right here on The Close. This is Bloomberg.
Season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead is coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Calamos Investments is launching a suite of exchange-traded funds that will track a portion of the returns of the S&P 500, the NASDAQ 100, and the Russell 2000, all while hedging 100% of the downside via the options market. There's a catch. Here with more, though, is Emily Graffeo, Bloomberg News cross-asset reporter. What is the catch? I mean, if you think about the idea of capturing these returns, why would you use the same product necessarily to hedge?
So one of the catches is that naturally, if you're paying for downside protection, you have to give up some of the upside. So these are ETFs from Calamos. The first one that's launching in May is going to track a portion of the S&P 500, but because of the options that the ETF has to purchase and pay for, they have to cap the upside. So in this case, it's going to give you exposure to up to 9.6% of the return of the S&P 500. That's not the only catch. The other thing that investors need to keep in mind is that the protection, the 100% downside protection, only works if you hold the ETF for a certain period of time. In this case, it's 1 year. So you have to buy it on the first day and hold it for a year to get the full protection.
Is there an advantage to doing that over just kind of hedging on your own?
Well, I mean, if you are an options expert, maybe if you're really good at figuring out the math, you can do it on yourself because you do have to pay for this ETF.
Right.
But if,
yeah, and I didn't even look at the fees.
Yeah, it's something like 69 basis points, I believe, was in the filing. Okay. But if you don't want to do that, if you just want this, product that you get some stock exposure, but you know you're not going to lose anything besides that upside.
But who are they pitching this to? Is it just sort of the rank and file traders? Is it retirees? Who?
Retirees. When I was speaking with Matt Kaufman, he's the head of ETFs at Calamos, he said this is a good product for people who want to be in the market. They can't afford to not be in the market, but they also don't want complete equity exposure. He also said that they're seeing some people have a portfolio with S&P 500 exposure, maybe 50%, and then they have a little slice of this hedged option.
You follow this, you follow this market really closely. Do they have other products like this out there, or is this kind of a one-off situation?
So this is the first ETF set to launch that's going to be 1 year. There's a product from Innovator, the ticker is TJUL, and that you have to hold for 2 years to get the 100% downside
I'm sorry,
protection.
I got to push back on this a little bit because the holding period is just confusing me, particularly if you're pitching this towards retirees. Retirees, I mean, they are like living the life right now. So they were able to participate in one of the greatest bull markets in the history of humanity. And now, just as that bull market is running out of steam, they get to go into treasuries and lock in 4, 5, 6% long term. Like, why would I want to lock up for 1 or 2 years in ETF when I could just buy, I don't know, a 10-year treasury at 4.5%? And guaranteed.
I mean, you're not wrong. It's,
okay.
Yeah, it's definitely for
I tell everybody that. Not everyone agrees with you.
4.5% or guaranteed 9%, I guess.
It's very enticing buying treasuries, scooping that up. I'm going to talk to a lot of people that feel that way. this is a product that's coming out. I will say BlackRock also filed for this. So people say that, they know something. So that hasn't launched yet, but that's another one. I think it's also 1 year outcome period, but 100% downside. Big caveats here, though. You have that period, and you miss out on the upside.
This idea of never losing money.
All right, Emily Graffeo over at Bloomberg. Great story, actually a great look here at some of the ETFs offering downside protection, 100% downside protection, Shanali, if you believe the marketing hype. All right, stick with us. A lot more coming up here on the program, including a closer look at what's been going on in the aviation sector. We are expecting Boeing earnings tomorrow. We got JetBlue earnings today. And they were bad, disappointing. The shares down about 18%. Stick with us. Helene Becker on deck right here on The Close on Bloomberg. All right, let's get a view from the sell side with our top calls. The big movers on the back of analyst recommendations. And we start out with Penn Entertainment, the gaming company getting an upgrade to buy over at Truist, with the analysts saying market expectations are just too low. Say the street is undervaluing the strength of the ESPN Bet Sportsbook partnership, along with Penn's other profitable interactive businesses. They're sticking with their $23 price target as well, and investors bidding the shares up by about 2.5%. Next up, Roblox scoring an upgrade to overweight over at JP Morgan. This on the prospects for new revenue streams. The analyst sees significant monetization opportunity as developers embrace Roblox's deeper push into advertising. The analyst saying that with nearly 80% of hours currently not monetized, there is a clear path to a windfall of Robux. Those shares having a pretty decent day, up about 5%. And finally, let's take a look at Five Below. JP Morgan not feeling as optimistic about the retailer, downgrading the shares to neutral from overweight, saying that it believes that cash-strapped consumers will soon get serious about curbing discretionary spending. They dropped the price target down to 170 from 215. Investors on the day dropping the price fractionally by about 0.6%. And those are some of our top calls. All right, we want to shift gears and take a look at one of the biggest movers of the day to the downside, and it is JetBlue. Those shares taking a hit today after first quarter earnings that the company reported, and its outlook signals some turbulence ahead, particularly in Latin America. Joining us now for more insights is Helene Becker, senior analyst at TD Cowen. She currently has a hold rating on JetBlue. All right, Helene, let's start off here with Latin America. We heard something similar out of Delta, I believe, as well as a couple other airlines, but we didn't necessarily see the same severe downward price reaction that we saw in JetBlue. What's different?
So I think one of the biggest issues is that for JetBlue, it's a bigger percentage of their total capacity than it is for Delta. And the other big part of it is Delta tends to serve fewer beach markets and serves more business markets than JetBlue. And for JetBlue, the real impact was in the beach markets. And for them, the visiting friends and relatives markets were a little bit better. So I think that was a big part of the difference between the two companies.
I am curious also, one of the other things that came up was just kind of about asset utilization and basically the capacity that the company has. I know there has been some costs here associated with grounded planes, as well as some of the other issues that they've been working on in certain markets.
Right. So one of the things they've been doing, because they have aircraft on the ground that are associated with the Pratt engine issue, they've been restructuring the network. And, they've spent, they've spent a couple of years now kind of being sidetracked, first with the Northeast Alliance that the government initially allowed, and then filed a lawsuit to make them disband it, the Northeast Alliance with American Airlines. So they were doing a lot of flights out of markets that maybe weren't core to JetBlue, but they worked with American and they worked well. Unfortunately, that had to be disbanded. And then the other major distraction was Spirit, right? That ill-fated merger, which cost them a lot of money, number one. And number two, they were focused on doing things with Spirit, with their network that would have made more sense. But because neither one of those two strategic directions were approved by the government, they've got to step back, refocus their operations on their own network, figure out what works for them. And for them, it means reducing capacity in Los Angeles, leaving 7 other markets, and refocusing on Boston and New York. And of course, that takes time and money. So I think that's a lot of what you saw in the first quarter, this whole restructuring. And then part of the loss was also associated with the $500 million they paid Spirit to leave the transaction.
You know, ever since the deal had died, certainly has been a tough road ahead. But what do you think would be the path forward here? Of course, investors are reacting pretty strongly to this print. What would change the story and help them turn around at this point?
Yeah, that's a great question. So one of the investor concerns, and that was sort of the title of our report this afternoon, is on the company's liquidity. People are really concerned about their ability to kind of get through this whole restructuring, because restructuring networks takes time and costs money. They've got $1.7 billion in liquidity. They've got a $600 million revolver that's undrawn, and they probably have some value in their loyalty program. The value is always, that's a tougher one because it's always whatever somebody's willing to pay. But it was estimated as having $1 to $2 billion of worth when they were financing the Spirit transaction. So even if it's the lower end of the range, they don't have any significant debt due before 2026. And they've restructured the delivery schedule with Airbus to push out deliveries to the right. So that will lessen CapEx. And I think they need to improve.
Right.
The revenue picture would be the sort of the number one thing that needs to get done.
Certainly a long story ahead for JetBlue. Our thanks to Helene Becker over at TD Cowen. We appreciate your time and your analysis there. Now, it's so interesting. A lot of people looking at this deal falling through because of the U.S. government and wondering if this is a better thing for the airline industry. I don't know. What do you think?
Yeah, I mean, it would be interesting to see. I was surprised just how much it affected their earnings, though. I mean, because we heard from Delta and American, you didn't necessarily see the same thing. We are going to hear from Boeing, of course, tomorrow, so we'll get a better sense here of what's going on with them and their plane issues.
And coming up, of course, we're going to go from airlines to cars. Tesla set to report one of their most pivotal earnings ever. We're going to speak to John Murphy, lead equity research analyst at Bank of America Securities. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Shanali Dasik. A lot going on in markets today. As we're saying, the buy button has been clicked on today.
Absolutely. You're talking about a 1.6% gain on the NASDAQ right now. The Mag 7, all 7, doing well today, including, of course, one important one, and that's going to be Tesla. They report earnings after the bell tonight.
After 7 days of decline.
Yeah.
And you can imagine they haven't even reported yet. And speaking of Tesla, remember, after a wave of bad news, it's set up for one of its most pivotal results yet. And investors will be focused on those margins, its robo-taxi, and the fate of its lower-cost EV. Joining us now is Corey Cantor. He's BloombergNEF analyst covering vehicle electrification. The latest research from BNEF shows that EV sales slow, but still stay over 20%. Okay, so they're slowing. How do you think about the next catalyst from here? Is the hype going to meet reality, or is that dead on the vine?
What I'd say is that we're really watching this Tesla earnings pretty closely, given that Tesla saw a decline in deliveries about 9% year on year at the global level, and regionally, Tesla doesn't give that breakdown. So if anything, we want to see what direction Tesla's looking at as it pertains to the US. That cheaper Tesla model is really important. If you take the cheapest Model Y today, which is around $36,000 with the IRA, Inflation Reduction Act tax credit. There's about 30% of sales last year that happened below that point. So what that means is Tesla needs to really change its game in the near term. And without that cheaper model, they're going to have to do something innovative. There's concern that they might just focus on the robotaxi during today's call. But if they want to really be growing in the EV space, they need to be bringing on more new models or lowering that upfront cost.
Well, the problem, though, is that what you just said, I mean, that's not like a quick thing to do. I mean, innovation, particularly even with robo-taxis, I mean, if you believe Elon that this is actually closer to reality than not. Right. But, let's face it, you have to take everything he says with a grain of salt. So it gets to the point here as to what does Tesla really want to be? Because at first it seemed like they were kind of a luxury car maker. Right. Then they said, well, we're going to go down the price scale, basically be everything to everybody. And then now, at least based on his public comments, they seem to be walking that back.
You're kind of caught in between two different strategies.
Yeah.
Right? You were originally seen as a kind of BMW or Mercedes competitor. Then you're aiming to compete with a Toyota, like a Camry or Honda Accord. You stop right before you get to that price point of the $25,000 to $30,000 car. Mm-hmm. It doesn't mean that Tesla can't get around there, but there needs to be a lot more clarity about the direction they're actually aiming to go in. And if you just shoot for the robotaxi, we have other companies like Waymo out there that have been testing robotaxis for a long time. That's a completely different business model. So when it comes to kind of an analyst perspective, Tesla really hasn't given much clarity in the past 6 months. And if anything, the kind of exit of some high-profile employees shows they might be moving in a drastically different direction.
Just so we're clear and our viewers are clear, so when he talks about the robotaxi, where's that revenue coming from? Where are these things being sold, or at least where would they be sold?
I mean, that's a big policy question, right? Yeah. You have to have these robotaxis approved in many different markets. Yeah. For robotaxis today, you really see a sense of, California, Arizona. But again, there's a lot of kind of steps to get approval there. Yeah. And that's a different business model than selling electric vehicles.
Yeah, and it's not even the whole state. It's just like a couple of cities.
Like a San Francisco.
Yeah.
You have to go through. So in terms of, that'd be a big shift from kind of moving down the kind of EV ladder towards more and more consumers. And in one last point, in terms of the short-term turnaround, right, with only the Model 3 and Model Y being high volume, how do you become a growth company again if you aren't making big changes to introduce more models?
That's a great question. I think one we're going to pose to our next guest, Corey Cantor, over at Bloomberg NEF, as we continue this conversation, a preview of what to expect out of those Tesla earnings after the bell. John Murphy joining us right now, Bank of America Securities Managing Director and Lead Equity Research Analyst. He has a neutral on Tesla and a 220 price target. And John, I do want to pick up with what Corey was saying here, is that, for investors, this was the ultimate growth story for quite some time. But we're now looking, at least if you believe the analyst estimates, we're going to see a drop in revenue for the most recent quarter and a significant drop in profitability.
Yeah, so, I think that, the hype around growth is really what we need to focus on, or the lack thereof, in the near term. When you look at this, that the news that the Model 2 might be canceled, I think threw everybody for a loop. And I think, Reuters uncovered some interesting stuff there. The reality is, without that Model 2, the growth narrative actually does change quite dramatically. And to be honest, that Model 2 is coming a little bit later than it really should be in the first place to keep the growth narrative going. But then sort of there's a second question around the robotaxi technology and FSD, autopilot, whatever you want to call it, the level 4 or 5 technology at Tesla, and really what that can do for the economics of vehicles themselves, right? Because right now we're seeing grosses compressed as pricing is coming down. But the big question is, can Tesla and Elon really change the economics of the vehicle that you buy, and potentially these robotaxis over time? So the math on all of our models would change quite dramatically over time. It wouldn't just be sort of the upfront point of sale or even subscription revenue. It would be sort of a longer-term potential tail.
There's the money that's being brought in, right? That's what we're talking about, the price points changing from consumers. But there's the money that they're outlaying. And if you think about the Tesla pivot here, how expensive is this going to be? And what potential does it have to continue to weigh on margins for a longer period of time?
Well, I mean, the reality of level 4 and 5 autonomy seems like even at Tesla or Waymo or Cruise at GM is years and years out. So I think that's a very fair point, that it will weigh on results, cash flow materially for years to come, which is why that Model 2, sort of on the more traditional side, would be so important. So I think you've got a number of years of waiting for this. And the reality is, nobody's proven to actually really make it fully work just yet. Waymo and Cruise have actually done a pretty good job. Elon and Tesla are way behind, which is why we're all sort of waiting with a bated breath as to the news either today or on August 8th with the robotaxi day.
Tesla stock today trading at $144. Of course, we've said yours is well over $200. What gets it there? How much risk is there to your price target at this point?
Well, with this stock, it's incredibly volatile to the upside and to the downside. And we all know that news flow and Elon's tweets, or X's, whatever you want to call them these days, has a major influence on the stock in the short run. So when you're talking about a growth narrative like this, you call it a hope or you can call it a factor on robotaxi, Model 2, or any products in the future. Really what people are betting on is Elon's ability to innovate and drive value over the long term. So we're hyper focused on short-term results here, which is something we all need to do as a financial community. But ultimately where this company lands in 5 or 10 or 20 years is really a lot more impactful for the valuation and the stock. So it really could be pretty volatile. And I think news that the Model 2 is coming and that the robo-taxi technology is actually working to some degree could be enough to really lift the stock in the short run. And a lot of bad news is already known by the market. Whether it's baked into the stock is debatable, but a lot has flowed in the last few weeks and really I think is largely in the stock at this point.
I am curious, so on the point of profitability, I mean, we know it's going to be probably a choppy couple of years as they sort of, pivot to whatever the next big thing is, John. We know they have the manufacturing capabilities. They can certainly compete on volume here. Are there cost-cutting measures, though, that the company can take, certainly in the short run, that would maybe give investors a little bit more juice until that revenue growth story comes back into play?
I think there's an opportunity to cut costs, but Elon has been cutting price to drive volume, very quickly. So, there are kind of two lines that are moving in similar directions, and the price cutting is actually moving faster than the cost cutting in the short run. To belabor the point on the Model 2, I mean, the idea there that it was going to cut costs or the bill of materials by 50% and really create a $25,000 plus or minus entry-level vehicle to really grow volume would be key. To do that on the 3 and the Y right now would actually be pretty hard and take years to get there. And I think, one of the things that we all need to recognize is the 3 and the Y pricing coming down as much as it is starting to overlap with that entry-level price points of that Model 2. So they need to be careful about the positioning of products sort of in the price spectrum and in the market in general, that they don't take that pricing down too far, then all of a sudden have some trouble slipping the Model 2 in underneath it.
All right, John, going to have to leave it there. Really appreciate you helping us out today as we look ahead to those earnings out of Tesla. John Murphy over at Bank of America Securities. Those shares higher by about 2% here on the day, though we should point out Shanali down about 30% since they last reported back in late January.
Yeah, and of course, I like the headline on the terminal, this idea of no man's land.
Yes.
A lot of these analysts have very divergent views on whether this is a negative or a positive catalyst for the stock, given not only the uncertainty around Model 2, but any other extraordinary issues that they might have.
And it gets to the question of identity. And I was trying to get this out of Corey, but it's kind of like, what does Tesla want to be? Are they going to be a luxury car maker? Are they going to be kind of like a GM where we sell everything to everybody across all price spectrums? Are they going to be a Chinese company? They're going to be an American company? There's so much there.
And at the same time, you have to wonder if that identity crisis spans across the industry. What does GM want to be in reaction to what Tesla wants to be?
Absolutely. All right, a lot more coming up here on the program. We're going to take a look at some other stocks on the move today. Lockheed Martin, RTX out with earnings a little bit earlier. Lockheed Martin actually reiterating its 2024 outlook, but there are still some big challenges up ahead. That's coming up next in our Stock of the Hour, right here on The Close on Bloomberg. All right, welcome back. Let's take a look at Lockheed Martin. First quarter operating income is in, and it did beat expectations. The defense company delivering more fighter jets and missile systems, and all 4 of its business units increasing sales in the quarter. Though we should point out the shares, which are having their best day going back to October, have given back all of those gains. Some concerns here about the outlook going forward. And Shanali, I did have a chance to catch up with the COO, Frank St. John, as well as the CFO, Jay Malavi, a little bit earlier to kind of ask them about whether they were going to stand by their full year forecast. This was the forecast they gave back in January. They reiterated it today, and they said, look, they have some confidence that they're going to hit those numbers, which is basically about $70 billion in revenue for the full year and roughly about $26 or so on an EPS per share basis.
You know, it's interesting. You're talking so much about the aid package as well. That happened after the first quarter ended. How does that really change the equation?
Yeah, they talked about that. We were just on Bloomberg Television. We saw it working its way through the Senate. That appears to be a done deal. So these includes money for arms sales to Israel, Taiwan, as well as to Ukraine, about $95 billion in that. A lot of that is going to flow to Lockheed. There was another contract that was just announced a few days ago, a $17 billion missile interceptor contract. Now, that's not reflected in the most recent earnings because that was actually posted after the quarter ended here. But that will flow through. Hopefully, we'll see that flow through into 2Q and 3Q and beyond.
It's interesting. As far as their business units goes, too, I mean, how much is really the war a backbone of their performance here? Their stock is only really up 2%.
It is.
Is it already all kind of priced in these contracts?
Yeah, I mean, they have kind of like two kind of big components. They have those really long-term contracts. These are like the F-35, F-16s, those programs that just take decades to work through here. Those are the long-term contracts. Then you have more of the short-term cycle stuff, and that's basically missiles, munitions, things that have to be replenished relatively quickly.
The presidential helicopter, does that count?
The presidential helicopter, which I don't know if we want to talk about that. They did not mention that on the call. They didn't really talk about that, but we had a great story on the Bloomberg, how they've had to actually put that on the ground for a little bit. Some issues. Did you hear about this? Apparently when the rotors go on, when it lands, it actually scorches the earth around it, which is apparently a no-no.
Well, I'm sure Joe Biden needs his helicopter back pretty soon. So.
Yeah, I mean, he's got places to go, I heard, I mean, you can't, Joe Biden ain't going to be riding the subway anytime soon.
Right. More markets coming up next. We're going to talk to Brent Schutte, the Chief Investment Officer at Northwestern Mutual Wealth Management. This is The Close on Bloomberg. Stick with us.
This is the countdown to the close. I'm Romaine Bostic alongside Sonali Basak. 10 minutes, Sonali, until we get to those bells. And it's going to be a big day here. We really start to get into the heart of earnings season. Tesla after the bell tonight.
It's been a big day already. We've had so much love in that stock market, a lot of green on the screen. You had a lot of negativity in the week leading up to this, really the weeks really leading up to this. And now investors putting cards back on the table even before you see those earnings come out. You have the S&P up 1.2% and even more love in those technology-focused stocks, especially those semis, and a bid in the bond market as well.
Absolutely. A little bit earlier, of course, we talk about what's sort of holding up this market, whether it's earnings, whether it's some of the concerns about geopolitics. But don't forget, monetary policy and inflation expectations still in play. We had a chance to catch up a little bit earlier with Alankar over at Janus Henderson and asked him about why he thinks Fed hikes have not had a bigger impact on the economy.
Monetary conditions have not been as tight as we think they are. At a Fed funds rate of 5.25%, if the neutral rate is 2.5%, which is the Fed's believed level of where economic growth and labor, the strength of the labor market is not too cold, it's not too hot, it's just about right.
And that was Alankar over at Janus Henderson helping us kick us off to the close just a little while ago. And here to help take us to the bells is Brent Schutte, Chief Investment Officer over at Northwestern Mutual Wealth Management. And Brent, I do want to start off with monetary policy and inflation. It seems, at least for right now, we've kind of put that to the side, the idea that everyone's focused on earnings. But we'd be remiss in not pointing out that the Fed's business is still unresolved here. And I'm not sure anyone really has a real handle on what the Fed is going to do next.
100%. I agree with your prior guess. I think the U.S. economy has been somewhat interest rate insensitive. I would put it a different way, though. If you think about consumer debt, a large majority is mortgage debt. And most mortgage debt post the great financial crisis was fixed rate. And so if you look at the outstanding mortgage debt in the U.S. economy, it's at 3.8%. Contrast that with the 7.5% that we're at right now, and you can see how a lot of people haven't actually felt this. That are a lot of wealthy people have actually probably seen net gains because interest rates have risen and they've been benefiting in their portfolios. Contrast that with lower income consumers where you are seeing some pain, where you've seen interest cost of consumer debt, of auto loans go up. And that's where you're seeing some of the pain right now. And I just think that's kind of more of a commentary on the longer rates remain elevated, the more they work their way into the economy. And I think the more they erode some of that strength in the U.S. consumer overall. And that's where I still think we have to face that music in the future, because I don't think inflation is going away. And I don't think the Fed's business is finished.
And so, I mean, based on what you just said here, you don't think the Fed is going to have enough of a cushion to cut this year?
I don't. We've been talking about rising inflation for some time now, and the market has kind of ignored it, as has the Fed. I mean, they kind of did their pivot in December when I thought we saw signs that inflation was moving the other direction. You could look at the Cleveland Fed median CPI. You can look at the service sector inflation, which on a trend basis is actually increasing. You can look at the distribution of PCE components rising more than 3% or 5%, and they all point to inflation being higher. And so to me, I don't think the Fed's going to be able to cut rates. And it all comes back to that narrative of how long does monetary policy have a lag. And I think in this cycle, it's been more just because of the dynamics of the U.S. consumer and corporations, which had termed out debt. But again, the longer it stays elevated, the more it works its way into the economy. And I still think that eventually leads to a mild recession somewhere down the road.
I mean, there's just been an incredible adjustment in the bond market, Brent, already. But what about the stock market? Do you think that the recalibration of expectations has fed through into risk assets?
I think it started to last week, and I think earnings probably this week are a nice distraction away from that. But I think we're going to have to face the music, like I mentioned before, on the inflation front and on the interest rate front and on the economy front. I think parts of the market have already discounted, and that's where it's a little bit odd when I talk about what we actually like. Look, we like small and mid-cap stocks. And those are more economically sensitive than high quality large cap stocks, which I think have been bid up on that. Who doesn't come on your show and talk about them being high quality, and who hasn't moved money there because of that? This is where I think expectations are important. And to me, small and mid with their discounted valuations already are discounting some sort of potential for a recession. And I think the irony of it will be once the recession arrives, they will probably draw down less, and then on the opposite side, do much better. And this is kind of what happened back in 1999, 2000, where we had a similar setup to today with a number of stocks, just a few stocks driving the higher quality S&P higher, while the rest of the stocks didn't benefit as much. And then into the recession on the other side, those names did very well.
But does that mean you're ready to put money into those small and mid caps at this point, given the volatility around them?
I think you need to start thinking about moving to where the puck's going to be. And so I don't think anybody has perfect timing. And to me, especially in this environment where you have a Fed who is very reactive and very forecast driven, seems to kind of shift around quite a bit. I do think eventually the Fed will be able to, or will have to actually cut rates fairly aggressively when that recession arrives. That could be the timing point for these names to start outperforming. But I wouldn't try to time that. And I think about maybe taking a little bit of a step in right now, because I think you already see a reflection of that in their valuations. And then thinking about accelerating that as you do get that market downside.
Brent, we'd be remiss in not getting your thoughts here on the earnings season. I know we're still early into it here, but I think everyone's sort of looking at corporate fundamentals. And I know, at least with these big cap tech companies, not always a true reflection of the economy, but this is what has kept the market afloat here. What's your general expectation?
Look, I think companies have jumped over lowered bars. I think the question going forward is how do input costs? And so wages are a large portion of companies' expenses, and wages aren't coming down. They're actually stalled out around the 4% area. And you see this in the NFIB, and so maybe another discrepancy between those big tech stocks and the rest of the economy. If you're having your input costs go up, you might try to raise prices, and you're seeing that. That's a no-no with the Fed, and so they're going to keep rates high. The question is, when do we start seeing margins erode, which would then cause potentially companies to actually have layoffs, which I think is still something that will occur in the future as these two things kind of have to work themselves out.
All right, Brent, always wonderful to talk to you. Brent Schutte over at Northwestern Mutual Wealth Management, the Chief Investment Officer there, helping us count down to these closing bells. Those bells now just a little bit more than 3 minutes away. And of course, Shonali, there's going to be a lot of discussion after the bell. We get quite a few earnings. I mean, more than just Tesla. We get names like Visa and Texas Instruments and a few others as well. But of course, Tesla is going to be the star of the show.
It sure is. I'm interested in Visa, too, just for that health of the consumer, the impact of the interest rates. Let's see if that creates any dent after the data this morning. The economic data is showing some weakness. But on Tesla, I've got to say, interesting drumbeat started. Top Live is already on the Bloomberg terminal.
Yeah, we're going to have full blanket coverage of this. We should point out right now the shares holding on here on the day, up about 2% as we head towards the close. The options market right now implying a move up or down of roughly about 8%. But we should point out the last 4 earnings reports that we've gotten out of Tesla, we've seen the shares drop by 10% or more each time here. Of course, the expectations coming into this earnings season a little bit lower, that bar lower as Brent was referring to. So maybe, just maybe, it won't be the big disappointment that it could be.
It certainly can here, and we're moving closer to that closing bell, Romaine.
We certainly are. Stick with us. We have our full market coverage as we break down all of the action today and everything that happens in the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Sonali Basak. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast. Carol Massar and Tim Stenovic joining us right now as we welcome our audiences across all of our Bloomberg platforms as earnings season really gets into full swing. Quite a few set to cross after the bell tonight, including Enphase, including
Tesla.
Chubb, including Steel Dynamics,
These are not
including
names
Mattel,
Tesla.
Including Visa,
Including
and oh,
Tesla.
right, I forgot that one, Tesla.
Who's your favorite child, Romaine?
Tesla. Stock is up 1.8% as we say. It's off its highs of the session, but we saw a rally in Tesla shares today. And speaking of rallies, guys, the S&P 500 now up 2% in the past 2 days. So different tone.
So we're awaiting Tesla. We spoke to Nancy Tangler over at Laffer Tangler Investment. She was just in our studio, and she said, we think a lot of the bad news is already priced into Tesla, and they could actually be adding to their position. They added at $180 a share, right now at $144 a share. So she acknowledged that she got in a little early.
Well, it's interesting, too. You have a lot of analysts that are still having price targets that are way higher, above 220 or so. So, of course, there is some buying appetite out there. The question is, what gets it there?
Yeah, I mean, what gets it there here? I mean, let's walk you through the numbers here because we're looking at analyst estimates right now of adjusted EPS of about 52 cents a share. That's a massive drop year over year. And even on a revenue basis here, we're looking at something around $22.3 billion, if you believe analyst estimates. That would be a 4% decline here. And it's been quite some time. I have to go back and look since we had a quarterly decline in revenue over at Tesla. Let's get you the closing bell numbers ahead of the earnings here. Green across the screen for the major indices on this Tuesday afternoon. It takes a while for these numbers to settle, but you see it there on your screen. The Dow Jones Industrial Average up more than 260 points, or about 0.7%. The S&P higher by roughly 60 points, or 1.2%. The Nasdaq Composite going to close out the day higher by more than 200 points, or about 1.6%. And look at this. Cyclicals and small caps getting in on the party. In fact, that was your outperformer on the day. The Russell 2000 higher by 1.8%.
Yeah, and taking a look at the S&P 500, most of the names in the index actually higher today, Sonali, about 388 names posting gains in today's session. And you've got about 111 to the downside, 4 unchanged.
It's interesting. You looked at sectors, still broad-based gains across those sectors here. Communication services, information technology leading the way, though you did have a strong bid in industrials and consumer stocks as well. Healthcare also up more than 1% on the day. Materials really your only loser on the day today, guys.
All right, real quickly, guys, as we await those earnings to cross, Tesla shares, as I mentioned, up 1.8% in today's session ahead of their earnings, still down more than 40% year to date. So sentiment obviously very negative here in 2024. Globe Life, ticker GL, number one gainer in the S&P 500. What? I know, an insurance company raising its operating earnings per share forecast for the full year, and the gain extending a bit of a rebound from a record drop earlier this month in this name following that short seller report. So number one gainer. Do we want to do some earnings here?
Texas Instruments crossing the wire right now. Is that what you're looking at?
That's what I'm looking at.
All right, well, let's do it here. Revenue coming in the first quarter at roughly about $3.66 billion. We'll round it up to 3.7. That would be a beat over street estimates of 3.6. EPS coming in at $1.20. That's versus $1.85 in the prior year here. So a bit of a drop there, though it does look like it came in above estimates. Here's your forecast going forward. 2Q revenue, the company guiding $3.65 billion to $3.95 billion. The street was looking for 3.8. Here's your guidance on EPS. $1.05 to $1.25 is what Texas Instruments is guiding for. The street Street was looking for $1.17.
Not getting a ton of commentary, at least in the press release at this point. Just going over the numbers, revenue decreased 16% from the same quarter a year ago, 10% sequentially. Revenue declined across all end markets. This according to the company's president and CEO. Also saying that the second quarter outlook is for revenue in the range of $3.65 billion to $3.95 billion. Earnings per share between $1.05 and $1.25.
Now, I also want to bring you some news over from Goldman Sachs. Goldman did hit the first record high since 2021 here. The shares have risen 1.6% here. And you have some interesting movements there on a day that you really have no interesting news, frankly. Yields are on the decline again, so maybe that's pretty good for markets.
Maybe says something to sentiment, like overall, right, that we've seen certainly over the last couple of days. Just watching, though, Romain, shares of Texas Instruments on that outlook. That stock now up about 5.8% here. So investors moving it, as we said, sees a second quarter revenue $3.65 billion to $3.95 billion. The estimate on the street is $3.78 billion. So investors definitely driving this one, although we're bouncing around a little bit, but still, for the most part, much higher here in the aftermarket for a stock that hasn't done much this year, down about 3%.
Yeah, absolutely here. But of course, a lot of people look to this, not quite in the zeitgeist when it comes to AI and chips overall, but it does give us a little bit of a peek here into one corner of that market, particularly because we're going to have to wait, I think, like another month before we get NVIDIA.
Yeah, exactly, right. And that's going to be a big one, right? That AI bet. Tesla shares, guys, just starting to cross the Bloomberg terminal, Romain.
All right, let's get you those numbers right now. Tesla crossing the wire. And let's go right to it here. The company coming in, EPS coming in at 45 cents a share. The street was looking for 52 cents a share, so a bit of a miss there. And remember, that bar was lowered significantly here. We have to look a little bit deeper into some of the numbers. There's some of the commentary coming out right away. The company's saying that it's updated our future vehicle lineup. They're also saying that they still see notably lower volume growth rate for 2024, but it does plan to accelerate the launch of new models going forward. Now, I should point out, we had a chance to catch up a little bit earlier with a couple of analysts, and they were talking about just this here, that yes, this quarter was going to be bad, but what they really wanted to hear, guys, was what is the pivot? What is the identity? Are we going to see a ramp up in production? And more importantly, in which vehicles?
Yeah, so let's, again, seeing the stock up about 6% in the aftermarket. We know sentiment has been really low. So again, first quarter adjusted EPS, guys, 45 cents a share. That is light. The street was looking for 52 cents. First quarter revenue, also light, $21.3 billion versus an estimate of $22.3. But again, looking to accelerate the launch of more affordable models. That's going to be key because that's been a pivot, or at least a tone, it felt a pivot in tone, if you will, from Elon Musk, that maybe it was backing off of a more affordable Tesla model, which would reach, as you know, Romain, a much more wider audience.
And wasn't this the big issue, right? Because when that report, I think it was Reuters, was one of the first to kind of report that Elon Musk was backing off of that. And then he came out on X and said, no, that's not true. But he's still got to articulate a strategy because we've seen the results here, not just in Tesla's numbers, but when you look at the competition from some of those lower cost or lower price Chinese models and even some of the lower price U.S. models here, we see where a lot of that market share is going.
Well, I'm going through the deck right now for the 2023 update, the quarterly update deck right here. And it's 31 pages. The company's saying that they experienced numerous challenges in the first quarter. They cite the Red Sea conflict, the arson attack at the Gigafactory, the gradual ramp of the updated Model 3 in Fremont. Their COGS per unit, though, declined sequentially, driven primarily by lower raw material costs. The company also saying, talking about the autonomous and electric future. It's saying that we believe scaled autonomy is only possible with data from millions of vehicles and an immense AI training cluster. We have and continue to expand both to make full self-driving supervised more accessible. We reduce the price of subscription to $99 a month and the purchase price to $8,000 in the U.S.
It's interesting. When you look, you do have them missing estimates, as Carol was saying, not just on revenue, but vehicles sold as well. But investors, if you take a look at the stock so far, shaking off the numbers themselves and looking at that update, the update also walks you through a lot of the sequential declines in volumes due to a lot of the issues around the world, shipping diversions caused by the Red Sea conflict. And to your point, really guiding investors to the future here towards artificial intelligence and also the deployment in capital that they're willing to put forward.
And this is what Tesla does, and they do it great, basically trying to guide towards that future. But I do want to just focus real quickly on the here and now, because when you go through some of these numbers in that most recent quarter, they were awful, and they were actually a lot worse than what some folks talked about. We talk about Model 3 production at that Fremont factory, down sequentially as they changed up the lineup. They'll talk about the production at that gigafactory in Shanghai, down sequentially once again, although they do expect demand to improve later in the year. Model Y production in that Berlin factory, down sequentially here. Well, you get the picture here. So the question isn't so much longer term, do they make that up? The question is, how long term is that going to be, Carol?
Well, it's always timing, right? How long it takes. And I'm looking through the deck, too. In 2024, Tesla says our vehicle volume growth rate may be notably lower than the growth rate achieved in 2023 as our teams work on the launch of the next generation vehicle and other products. In 2024, the growth rates of energy storage deployments and revenue in our energy generation and storage business should outpace the automotive business, which is something we were talking to Nancy Tengler about. Was it the battery? But the battery business and the importance of that actually to the Tesla story that doesn't necessarily get a lot of attention. Hey, one other metric, first quarter gross margin, 17.4%. The estimate was 16.5%. So that's coming in better than the street forecast.
Page 10 on this presentation, I think that this is a bit of the money area that a lot of investors will be looking at here. This idea of the lineup for the new models accelerated ahead of the previously communicated start of production in the second half of 2025. These are the new vehicles, more affordable models that they're looking to bring to market faster. And they do talk a little about the robotaxi here, continuing to pursue a revolutionary unbox manufacturing strategy. So that is the outlook. That is page 10, right before you get to the market share here. But it does come right after they lay out all those challenges ahead.
Isn't this important? If they're committing, it feels like a fair amount of time and like making a point to talk about the launch of more affordable models. As we talked about, Romain, earlier, the reports, the back and forth of like, are they not going to do this? This is so important to the story going forward.
Yeah, absolutely, Carol.
All right, guys, we got to wrap. I know you guys got more on your side, but we are seeing shares of Tesla definitely rallying in the aftermarket. All right, that's across platform, radio, TV, YouTube, Bloomberg Originals, breaking down, of course, those Tesla earnings. We will see you again, same time, same place tomorrow.
And we continue our coverage of those earnings out of Tesla better than any other. The shares higher in after hours, trading by about 5%. Adjusted EPS did come in at a miss, about 45 cents. The street was looking for 52 cents a share. Revenue also slightly lower, 21.3 billion. The street was looking for 22.3 billion. But the shares higher, apparently on the longer term outlook here, and the push to shake up that lineup, potentially more affordable vehicles. Ed Ludlow joining us right now, the co-host of Bloomberg Technology. And Ed, let's start off with the long term here, because I think this is what everybody really wanted clarity on, which is their lineup is stale. Let's just face it. They've got a lot of competition now from all the legacy automakers and whatever the heck China is doing. What they're saying right now, while it's light on specifics here, provide some context here as to where Musk really wants to move this company over the next couple of years.
Well, I think definitively the shareholder deck in the first instance gives exactly what the institutional or Wall Street giants who had a more affordable EV at the heart of their bull thesis, what they wanted. And it gives the larger retail investor base who believe in a robo-taxi future what they wanted. What Tesla is outlining in this shareholder deck is completely consistent with what Dana and I reported Sunday night in the Big Take. We reported via sources that a large body of work went in at the component level and at the production process level to bring a range of more affordable EVs, not just one single model. That is exactly and explicitly what Tesla is saying in the shareholder deck. At the same time, they also are pretty explicit that a purpose-built robo-taxi is coming. You will remember that Elon Musk refuted the idea, first reported by Reuters, that an affordable EV program was scrapped or cancelled. Clearly it's not. Tesla's explaining in the shareholder deck that if anything, it's being pulled forward ahead of their original timeline of late 2025. So there's some consistency there, though you cannot hide from how terrible a quarter the first quarter was for Tesla in the near term.
I'm really interested in that idea of pulling up the timeline here. They said that they will accelerate the launch ahead of that communicated start of production in the second half of 2025. How fast can these things get out there, and how important is it that they get out there quickly?
Yeah, I mean, let's be honest. Elon Musk has a track record of not meeting the deadlines and timelines that he's set himself. He often delivers the end product just later than expected. But I think that what's interesting here is that in the first quarter, clearly the deliveries number missed. And if you look at the financials, both at the top and bottom line, it was not a great first quarter. The strategy of cutting prices to the bottom did not open up new addressable market. It didn't help them improve volumes. So the long-term thesis of many institutional investors is like, look, you need to do what the car industry's always done. Offer many more models very quickly at a range of price points, but particularly low price points. And just reading the specifics of the deck, that's what they say they're going to do.
Yeah, and they should point out, too, I mean, they are warning, at least in this presentation, that while there are a lot of long-term benefits to this, Ed, in the short term, they're saying that this may result in achieving less cost reduction than previously expected. They did not quantify that. But I want to read something else to you that they had in here and get your thoughts on it. And this has a little bit more to do about this idea that they're kind of on the precipice of sort of some new expansion. They say we're currently between two major growth waves, Ed. The first one began with the global expansion of the Model 3Y platform, and we believe the next one will be initiated by advances in autonomy and the introduction of new products.
Yeah, my reaction to that is the first wave of growth, which Elon Musk probably has previously stated that phase between two waves, right? But let's think about wave one. Look at the inventory numbers. Tesla has 28 days of inventory of its existing products. That is an all-time high. Those vehicles are not selling. But benefit of the doubt, in the first quarter, they started to recognize higher software revenues from full self-driving. There was a sprint finish in the month of April to onboard more customers, and you guys will remember the reporting that Elon Musk was making it mandatory that if you went and picked up a new Tesla, the sales rep had to demo FSD for you. Well, that's also there as well. Higher FSD revenue recognition year on year, better software sales. But now we're in the middle, and there's probably likely to be some short-term pain where even with continued price cuts, Model Y and Model 3 where they're currently at, and Cybertruck being low volume, that's not going to be the driver of growth. Selling the software is improving, but it's nowhere near the future that Elon Musk envisaged. So it all goes to the call. Time for earnings call bingo, time for the top live blog, and let's actually get some concrete clarity. But the stock being up 8%, Romain, I think it really speaks to this idea that if you are the Wall Street investor who wanted the cheap EV, or you're the technology romantic who wanted the robo-taxi, you got a bit of both.
All right, Ed Ludlow, the co-host of Bloomberg Technology, helping us break down those Tesla earnings. Full coverage right now on the Bloomberg terminal on RT Live, and full coverage right here on Bloomberg Television continues with those shares higher by about 7% here in after hours trading. A miss on EPS, a miss on revenue, a beat on gross margin in the most recent quarter, but cash flow still looking healthy, I should say. And of course, Elon Musk saying that look into the future here. They're going to rejigger that lineup here and pivot to the next phase. Now, of course, that next phase has a lot to do with EV adoption overall, not just for Tesla, but really for everyone writ large. Let's get some insights out of Jessica Caldwell, the executive director of Insights over at Edmunds.com. And Jessica, I want to talk a little bit about EV adoption overall, because heading into this quarter, we knew what ailed Tesla itself, but it was also something that kind of ailed all the automakers. We certainly saw that growth in EV adoption slow a bit, and some of that money, some of those potential sales shift back to either ICE vehicles or in some cases to hybrids. What have you been tracking?
Yeah, I mean, if we look at EV sales in the first quarter, they're pretty flat from where they were for full year 2023. And if you look at EV adoption growth charts from a few years ago, that was not supposed to happen. Things were only going to get better for this. But I think we're hitting a bit of an inflection point in this market where a lot of the early adopters and people that are truly interested in EV technology have purchased cars. The next frontier is getting more mass market consumers to buy these vehicles. And at that point, that's a challenge for everyone, not just Tesla. It's not just about price point. It's getting people comfortable with this new technology. And that's always going to be an uphill battle, something that the industry was always going to have to take on. But that's kind of where we are. And that's probably a big concern moving forward.
There's two things I want to unpack on there. I mean, one, of course, is charging. But I want to start with pricing, because there's been a lot of talk about this. Anyone who shopped for an EV knows most of these vehicles come at a pretty decent premium. I think there are a couple on the market that are maybe competitive with ICE vehicles, but you're paying a premium for this. Is it about the capacity of consumers to pay that premium or the willingness of those consumers to pay that premium?
It really is both. I think right now, probably the biggest issue for the industry is the willingness, because even if you look at a lot of EV vehicles right now, they're sitting on lots for a long time. There's big incentives dollars. If you lease an EV, a lot of those prices are pretty good. I mean, as good as you're going to get with an ICE vehicle, maybe even better in some cases that you're going to get with a hybrid vehicle, because there's much bigger demand there. So I think getting more people into EVs is really the challenge. And it's not just about people that are in big cities and, they like to have the latest and greatest in technology. It really is just the average American. And that's a big hurdle to climb. So I think the willingness of consumers is really what Tesla, but all the automakers are going to have to really get behind.
Jessica, what's a bigger problem here? Consumer preferences when it comes to the EV switch, or the infrastructure? This idea that the charging stations may not be enough to go the extra mile, if you will.
Yeah, I mean, technically it is the infrastructure. When we talk to consumers, the issues are pretty much what you think. It's range anxiety, it is battery longevity concerns, it is price, and it is infrastructure. But the one thing that does consistently come up is that people just don't want the hassle of owning an EV. And they conceive it as such a hassle because they have to do something different. And that, I think, is the worrisome. So the education piece and infrastructure development and making it easy for consumers is probably what's going to have to happen for these sales numbers to go up. And that's easier said than done.
Well, how much do people really want this transition? If the price cuts may not be enough necessarily, then how low do you have to go to really bring people into the idea?
Yeah, I mean, I think that price is obviously a big one. And if people do have vehicles that are pretty, cost efficient for the average consumer, because it's not just about vehicle price. It's a lot of consumers are shopping monthly payment right now. It's how much do I pay per month, and that has to do with your credit score, interest rates, all of those things. So that, I think, is really important. And then just showing those people that kind of sit on the fence about, should I get a hybrid? Should I try a plug-in first? Maybe I should do an EV. I don't know. If I go on a road trip, what's going to happen? I've seen cold weather issues with some of these EVs. It's just kind of getting people more comfortable with the idea of owning an EV. And that just is going to require, I think, time and a lot of awareness.
All right, Jessica, always great to talk to you. Jessica Caldwell over there at Edmunds, a closer look at the broader EV space. And we talk about that price point. And quite frankly, a lot of these vehicles are actually luxury vehicles. But there's a lot of new entrants into the space as well, including GM's Cadillac division. The Cadillac Lyriq has actually emerged as a rising star, outselling EV models from Mercedes and BMW. Kyle Stock wrote up a great piece on this on the Bloomberg earlier today, and he joins us now to talk a little bit more about these new entrants. And Kyle, let's start off specifically with the Lyriq. I remember when this was first kind of being teased, and it seemed like it was forever. Like, there were advertisements like 2 years ago, even though you couldn't buy this thing. What has the adoption been of this, particularly given how high the price point is?
So what we've seen, there was a lot of interest right when it was announced. And then there were some huge production delays with GM that kind of was a faltering start. But now the factory is humming, they're hitting orders, and they just had two really big breakout quarters for this car. So in the first quarter of this year, they sold almost 6,000 of these in the US. So it's a big number. It's a big number for any EV, but it's a really big number for Cadillac.
Yeah.
And the car is really hitting him resonant here with consumers.
So, Kyle, I mean, how much are we talking about for this car? I mean, I've seen kind of like base prices around like 60 grand, but I always feel like those numbers are kind of a lie, particularly when it comes with EVs.
Yeah, this one's fairly modest, especially relative to something like the BMW iX, which is the competitive SUV from BMW that starts well over 80 grand. So this will start at right around 59,000 and tick up about 10,000 from there. So in this set, it's actually priced fairly low. So it's more expensive for sure than a mainstream electric vehicle, but for what you're getting here, there's a lot of value, and that's part of what's clicking with consumers.
But it's interesting. We're just talking about the idea of the price point for just kind of everybody else when it comes to EVs. When you're thinking about more luxury vehicles, what's the cultural idea here? What's the sell? Is the idea to have a luxury electric vehicle as a status symbol, or is it something else?
It's a little bit of that for sure. I mean, this is hitting with a consumer that maybe isn't so worried about interest rates. Maybe they're not so worried about the price point. A lot of folks are buying these as an extra car. So they're not trading in their main vehicle. They have 2, maybe 3 cars in the garage. They want to go on a road trip. They're not taking the EV. But there's a newness here that's striking a chord with consumers. And we're not seeing a slowdown among luxury EVs as much as we are among the EV market on a whole. So this is a part of the market that's really holding its momentum. Some of these cars are really performing well and posting gains. So it looks more like the regular car market. There's hits, there's winners, there's losers, there's vehicles people aren't excited about, so they're not buying them. It has nothing to do with technology.
Yeah.
And this is one that people seem to be excited about.
All right. Well, great reporting, Kyle. We talk about that Cadillac Lyriq, about 6,000 sold. That beats out Mercedes, beats out the BMW iX, beats out the Audi Q8. Not necessarily beating out Rivian, 8,000 sold there. Kyle Stock of Bloomberg News. As we continue this discussion right now with Ross Gerber, co-founder, president, and CEO of Gerber Kawasaki. Of course, a big backer and investor in Tesla. And we should point out, I was going through those numbers, Ross, of what Cadillac sold or what Rivian sold. We should point out that pales into comparison, obviously, as to what Tesla is selling, actually delivering more than 300,000, almost 400,000 vehicles in the most recent quarter here. What is the identity of Tesla to you? Is it a luxury car maker, or is it just kind of whatever it wants to be these days?
Well, it started off, I think, as a luxury car maker with the Model S 10 years ago and the Model X. And I think they really appealed to luxury car buyers for many reasons at that time. But it's moved on to being a mass seller of vehicles, more similar to the vein of Toyota than, I would say, a higher end car company like Porsche. And so, Tesla's goal was to bring, EVs to the masses. And I think that should still be their goal. And they're achieving that. But I don't look at the brand in competition with things like the Mercedes or the Rivian, for example.
Well, let's talk about some of the competition with, I guess, more affordable models. And I kind of put that in quotation marks. But we saw a lot of competition from some of those lower cost vehicles coming out of China, right, and even a couple models here, like from, I think it was Kia or Hyundai here.
Yeah, Kia.
When you hear what Tesla had to say in that press release and that investor deck today, that they are still focused on some sort of affordable option here, how much is that encouraging to hear?
Well, it depends what the actual fact is, because it was a very vague statement. And, quite frankly, a used Model Y on the market today sells for about $25,000. So, you can actually buy a $25,000 Tesla today. I'm actually selling my Model Y for a Rivian should be this week. And, I'm getting $25,000 for it. So if you want to buy a $25,000 Tesla, they're online. Just buy a used one.
Well,
and I think that's part of the problem.
Is there not a premium for a Ross Gerber pre-owned Tesla?
Well, I wouldn't do that. I wouldn't do that to somebody,
Ross, realistically, these numbers, they missed the mark, but they've given this outlook here that investors seem to be latching on to. What is your story here? What do you need to hear to be happier with the stock at this point?
I think really what I want to hear is that Elon understands his role at Tesla and Twitter as a conflict of interest for the sales of Tesla cars, and that he is aware that his actions do affect the consumers that are buying his vehicles. And so if people perceive Tesla as Elon Musk's car, we're not selling any of them. But if Tesla can brand itself as Tesla, which is what we've been pushing it to do, people want to buy Teslas and they love the car, and it's still the best car on the road. So I'd love to hear him. I'd love to hear him say he's going to stop tweeting divisive things. I'd love to see him refocus to actually working at Tesla. That would be
Ross, great. The update that they gave today, this idea of the pull forward in the production here of the cheaper cars, the new vehicle lineup, is that enough for you? What kind of aggression do you need to see in the change of strategy?
Well, I just don't believe that statement. I don't see how they're going to pull forward production of this vehicle to be ready in a year after they just laid off 15,000 people and a lot of factories and a lot of high quality individuals just lost their jobs. So I'm kind of curious to, we can say things, but we know that when Elon says something, it often takes 4 years after the initial comment. Yeah. So I can't rely on what he says as a time frame, because those are usually his goals, not necessarily a reality. So I'd love to hear clarity of exactly what's happening, what vehicle will be produced. Is he making a $25,000 car? Is it really going to be ready in a year? I mean, it would be great to get clarity on this.
Do you think that investors like yourself, or really any investor, are going to kind of give him that time, that long leash, if you will, to work this out? Because, like I said, you mentioned it, when he starts saying, well, okay, we're laying off all these people and all this, but then at the same time, he's saying we're going to sort of produce all these, come up with new models and things. I think they seem kind of contradictory here. But I mean, in fairness to Elon, I mean, he canceled that trip to India. He does seem, at least in the short term, to have sort of refocused on the fact that, oh yeah, I've got this gigantic company that I'm supposed to be running, rather than just, tweeting and running around the world fighting culture war issues.
Yeah, I mean, that would be great if he really understands this at this point, but I don't think he wants to be accountable to shareholders of Tesla or anybody. So once again, it's up to him. If he wants to make Tesla successful, he can make Tesla successful again, and I hope he does because we still have a lot of shares. But if he doesn't, and if he doesn't start focusing, what we fear is this is as good as Tesla's going to be. And so until somebody actually like really cares about making Tesla better, the CEO, like I just don't see how Tesla gets better. And that's what our fears and why we've lowered our stake in Tesla over the last year is that we saw a lot of this coming because of their lack of advertising and lack of focus and the divisive nature of Elon. He's just turned a ton of people off.
Ross, we got to leave it there. We thank you so much. Looking forward to seeing what you think after the call as well. That is Ross Gerber of Gerber Kawasaki. Now coming up, big tech earnings top of mind for investors. We're going to get a feel for what to expect from Melissa Otto, head of TMT research at Visible Alpha. This is The Close on Bloomberg. Stick with us.
All right, let's turn now to Tesla's China operations as EV competition in that region continues to heat up, putting a lot of pressure on Elon Musk. Bloomberg's auto reporter David Welch joining us right now from Detroit. And David, there's some interesting reporting over the last few months really about just how much the Chinese have sort of advanced when it comes to offering not only a variety of EV models, but more importantly, models that are a lot more cost effective, if you will, than some of the Tesla models on the road over there.
The Chinese auto industry has a huge advantage in the whole supply chain for batteries, whether it's the processing and mining of minerals, battery technology itself. They've got a labor cost advantage for that matter, and all of that results in much cheaper EVs from BYD, SAIC, and some of the other companies that are making many other companies making electric vehicles over there. And it's really hit Tesla pretty hard. It's also hit the likes of General Motors and Volkswagen pretty hard because they don't have enough EVs for that market. And the government uses both carrot and stick to get people to buy them. Tesla, a couple years ago, made a big bet, and it was really working for a while. But now that they've only got more expensive vehicles compared to what's over there, even the price cuts haven't really kept the company from losing a lot of ground to some of the Chinese domestic auto players.
How does this play out over the next couple of years? Is there anything that would turn this trajectory around, David?
Well, look at earnings today. In the letter, it's very vague. Elon's often vague when he doesn't have any solid news to report. Very vague statement that they're still investing in affordable Teslas off their future vehicle platform. Some of the investors, and probably the reason the shares are up after hours, are interpreting that as that $25,000 EV may still be in the works, even though there were reports out there saying that it had been either canceled or delayed. One thing is for sure, I think between lowering prices and looking at future models, they're going to have to put out some cheaper electric vehicles in order to stay competitive in that market, and for that matter, to keep gaining market share in the United States and in Europe. Chinese automakers are also gaining big ground in the European market against the manufacturers there. Yeah. And Tesla's got their Berlin factory, so they need to compete everywhere with Chinese EV makers who have a cost advantage.
Yeah, absolutely. And then, of course, I mean, there's obviously this big push that we've been learning about that Xi Jinping is making, basically to make it a cleaner environment overall. So not just with EVs, but really pushing households and creating incentives, whether it's trade-in programs for old vehicles. And I guess my question is that we made a lot about Tesla's entry into China. First mover advantage, if you will, whatever sort of technology advances they get from that here. Does that not help them in this situation?
It helps them. The problem is the Chinese have very good technology. The brands there were once sort of seen as not quite as good as the foreign automakers, as the imports, and now the quality is very good. The vehicles themselves, they're well styled. The interiors are nice. They're not just competitive vehicles. In a lot of cases, they're better vehicles. They learned a lot, the Chinese automakers, from their partnerships with General Motors, Volkswagen, Toyota, all the other car companies who had to do a 50-50 JV just to get into that market. And now the training wheels are off. They're making very good vehicles. Mm-hmm. And even though Tesla did get in there with a lot of goodwill from the Chinese government, by the way, it's that's not enough to win over the consumers over there.
Yeah.
They're still selling vehicles, and they'll still do pretty well, but it's going to be tough for them to compete going forward.
David, we thank you so much for your reporting. That is Bloomberg's David Welch. We're going to stick with China because Apple faces its worst start to the year in China since 2020. iPhone sales fell last quarter 19%, according to data from Counterpoint. Meanwhile, sales for rival Huawei rose by almost 70%. Bloomberg's chief Apple correspondent, Mark Gurman, joins us now on this. How do you think about the dynamic of Apple in China? It's interesting, with the love that you've seen in the Magnificent Seven, this news really just came out hours ago of this idea of that China slumping that drastic.
It's interesting. Apple sales in China fell about 13% last quarter, right? In the prior quarter, they reported at the end of 2023. And Tim Cook was pretty quick to say on the earnings call during that time that this decline in China is not due to the iPhone. In fact, he said that he believes the iPhone actually grew in China. And I think that was a way to push back, despite the $2.5 billion annual decline during that quarter, against the idea that the iPhone is faltering in one of its most important geos. But the reality now seems that it is the iPhone. And now we have Counterpoint research out today with this report that iPhone sales in China are down 19%. Now, like Shanali, like I've said in the past on your program, you can't take these numbers at face value, right? I would be very surprised if the iPhone actually fell 19% in China. Yeah. Now, Apple's not going to say one way or another, but I still think it's directionally true.
Right, and I think the direction is still going to cause some people a little bit of agita, whether it comes at 19 or 9 or whatever down, because I saw some statistics that actually showed that overall handsets, smartphone handsets, are actually up here. So this isn't sort of an industry-wide problem. This is obviously something specific to the brand.
Right. Apple loves an industry-wide problem when their numbers are down because they get to point to it and say, this is not just us. But Romain, you're completely correct. This is not an industry issue. You saw Huawei, Honor, some of the other brands in China. They're either like stagnant or down or up considerably, right? And so this is clearly an iPhone issue in China. My assumption is they're going to give the runaround on their earnings call on May 2nd. They're going to say it's not a fair compare to the iPhone 14 Pro because the 14 Pro had pent-up demand during this period a year ago because of COVID lockdowns at the end of 2022. But the reality is it goes well beyond that, right? They need a new hit product. They need new marketing. They need a new direction in China. I wrote over the weekend that Apple should probably launch a lower cost iPhone geared directly towards developing markets to really compete with Huawei, Transmission, and some of these other lower tier phone makers, Oppo, Vivo, etc. Yeah. I don't think they're going to do it, but they probably should if they want to get back on track and try to gain some share there, even though that hasn't really been their priority.
All right, Mark Gurman, who covers everything Apple for us here at Bloomberg. Remember, Apple earnings scheduled to come out next week. Meanwhile, in the here and now, we did get those Tesla earnings, the first of the Magnificent Seven to report, but we got quite a few on tap in the week ahead. Meta, Alphabet, Microsoft reporting this week, as are a few other tech companies not in the Magnificent Seven, including IBM. To look ahead to some of those reports is Melissa Otto, head of TMT research at Visible Alpha, an investment research firm with a focus on tech and software analysis. Fitting that you're here. Great to have you, Melissa.
Thank you so much.
All right, so let's push ahead here. I mean, what exactly is the story that we're looking for out of this earnings season? Because I think for so many years, for all of these companies, at least in one basket, it was just about growth, right? Revenue growth, cash generation, they couldn't go wrong. But we're starting to see some fractures around the edges here.
It's a really interesting backdrop right now. Coming in over the past couple of months, we haven't seen our data really moving much from last quarter to this quarter for the large cap tech companies, which is interesting. It implies that essentially analysts came out, they set expectations, and it stayed there. There hasn't been a lot of movement around the top level sales and earnings fundamentals. However, digging into some of the nuts and bolts of the segments, the divisions of some of these large cap companies, particularly Microsoft and Alphabet, there are some interesting stories to be told. One being around Microsoft's Azure revenue.
Yeah.
Is this their iPhone moment? Is this the moment that the AI business really starts to transform and drive the company forward?
Yeah.
Could we start to see some earnings revisions?
How much stock do you put in that AI story? Because even in Tesla's release, they talk a lot. They don't say AI, but they talk a lot about automated technologies. We know Microsoft has obviously made that big push and investment in the AI space, Amazon as well, and at some point Apple will articulate an AI strategy as well. Is there substance to that, though?
That's what we're waiting to see in the numbers. That's certainly coming into the quarter based on Visible Alpha consensus. The Azure revenue is expected to generate $74 billion this year, $94 billion next year, but that number hasn't moved much.
Okay.
And so could there be a shift as we hear what they're actually doing?
Given the run-up we saw last year and the hiccups, as Romina alluded to this year in the market, when it comes to big tech stocks, how do you think about the trade moving forward? Where are the best opportunities to gain?
One of the most interesting stories right now is actually a company, is an Alphabet. Alphabet right now hasn't really seen its overall estimates changing that much. However, if we go beneath the surface and take a look at the Visible Alpha consensus for the Google Cloud operating profit margin, there's an interesting story there. Coming into Q1, the market was initially expecting 8.7%. Now they're expecting 7.3%, which implies that there's some building conservatism around that business. And if we compare it to last year, it seems okay. The company delivered a 5% operating profit margin last year. Coming into this quarter, I think there was a much more positive sentiment, and now it's kind of tapering off a little bit. It'll be very interesting to see how they guide and what the rest of the year will look like for the company.
Just in a couple of days, you have Alphabet reporting as well. For this earnings season, what are you watching most closely? What do you think is the biggest surprise ahead?
I'm going to go back to Microsoft. I mean, I hearing what's going on in the Azure business, the Azure AI business, understanding more deeply what's happening around OpenAI, what types of innovations they're going to be bringing to market, what their guidance is going to look like. These are going to be some really pivotal questions for the stock.
Melissa Otto, we thank you so much for your time. That is Melissa Otto of Visible Alpha, all across the technology landscape for us. We're going to take a look here at some earnings that have crossed the wire in the last hour. Of course, we've been talking about that jump in Tesla. Really, Elon Musk starting to lay out that strategy for rolling out new vehicles. Tesla shares now up more than 7%, 7.3% nearly, fluctuating a little bit around there. You also have Visa, also profit climbing 17%. Those consumers, they're still strong. They are spending on their credit cards, and you have a 2.7% rise. Aftermarket. Texas Instruments, also good sign ahead. Solid forecast giving signs of a comeback, a bullish revenue target here for the current quarter. And the idea here is that a slump in demand might be easing for industrial and automotive parts here. Of course, they are also a bellwether here for confidence in the economy and has a large base of customers in the chip-making industry. You have Texas Instruments up now more than 5.7% remaining.
All right, I'll throw another one on the screen. Pepsi shares actually were down on the day, down the most going back to earlier this year on the back of earnings. So what better excuse than to talk about, well, a day that will live in infamy for the soft drink industry. We're going to take a look back at the debut of New Coke, one of the biggest blunders in corporate history. And a question before we go to break, Shanali, this is for you. How long did it take Coca-Cola to do an about face on New Coke and return that classic formula to the shelves?
I have no idea.
The answer when we come back. This is Bloomberg. All right, it's time for this day in history, and we go back in time to April 23rd, 1985, the day Coca-Cola introduced an updated and sweeter version of its flagship beverage, changing a secret formula first introduced in 1886. The product, it was officially called Coke, but the CEO at the time, Roberto Gazzetta, insisted that the pop can display a banner with the word new on the side, and thus the unofficial moniker of New Coke became de facto official. Now, to say that the CEO was proud of the pivot would be an understatement. In interviews at the time, he called New Coke smoother and rounder and the boldest marketing move in the history of the consumer goods business. Those consumers, they couldn't have disagreed more. They flooded the company with angry phone calls and letters. They poured New Coke into street gutters in public protests. They booed when New Coke advertisements flashed on sports stadium scoreboards. They even went so far to form a group called the Old Cola Drinkers of America and filed a class action lawsuit. That lawsuit was dismissed. Everyone was piling on. Cuban dictator Fidel Castro threw shade, calling New Coke a sign of capitalist decadence. The Pepsi president, Roger Enrico, he dubbed New Coke the Edsel of the 1980s, referring to Ford Motors' famous car design that flopped decades earlier. Now, to be fair, New Coke was hardly the only major product launch to fall flat. Remember Sony Betamax, the Apple Newton, McDonald's Arch Deluxe? Even Coke's main competitor had its own comeuppance in the 1990s after failing to convince the world it needed Crystal Pepsi in their lives. Now, oddly enough, New Coke, it was actually kind of good for the company's bottom line. At the time, cola sales industry-wide were slumping, and Coke had been steadily losing market share to Pepsi. In fact, sales of Coca-Cola overall actually rose 8% after the new formula's debut. But executives, they were growing too concerned about the public backlash and the effect on its brand reputation. So 3 months after the debut, Coca-Cola did an about-face. Just 3 months had passed, or 79 days to be precise, when the company put the original formula back on the shelves, rebranded as Coca-Cola Classic. Senator David Pryor of Arkansas hailed it as a meaningful moment in U.S. history. Now, that might be overstating it just a bit. As for New Coke, it did live on for a while. Renamed Coke 2, it was sold in smaller and smaller quantities over the years until finally being discontinued back in 2002. And the company itself has actually embraced the missteps, briefly reviving New Coke back in 2019 for a promotion with the Netflix series Stranger Things. And on its website, it even pokes fun at itself, tongue-in-cheek, saying, to hear some folks tell it, April 23rd, 1985 was a day that will live in marketing infamy.
There's more infamy to talk about here, Romaine, because it's time now for the top three. Every day at this time, we do a deep dive into the people at the center of today's top stories. And first up, I'm watching Larry Culp, the CEO of GE, because GE recently managed to offload Crotonville. You might know it as its management training facility. The news is leading up to sort of a running gag about GE-bred CEOs and their reputations as leaders. On some hand, there is a good riddance kind of vibe to this, Romaine.
Yeah, I mean, this was the house that Jack Welch built. I started my career covering this company, and I would make trips out there. And it was like the CEO factory. They were just spitting them out. They were going to other companies and have a lot of success. But I don't know if it's necessarily it was a bad model. I just think times have changed. And I think what they taught there just doesn't necessarily apply in this modern age. Now, another person I'm keeping an eye on is another CEO, and that's over at Cleveland Cliffs, the very outspoken Lorenzo Gonzalez. He was actually had a few choice words about the possible U.S. Steel Nippon deal, telling analysts on a call, it still baffles me to this day that the clueless individuals representing Nippon in this embarrassing event felt that they could do this without union support. Never one to mince words here. Not sure if he's going to put his money where his mouth is, but certainly not very plussed about this deal.
Fighting words. This was supposed to be the white knight in that U.S. Steel deal, and now it's seemingly gone away. Of course, a lot of challenges for the steel industry. Lastly, I'm watching what's going on in a luxury at Kering, the parent company of Gucci, because some investors and analysts are now questioning whether CEO François-Henri Pinault is the right man to turn things around after a sharp decline in revenue. Is he the right man?
Yeah, I mean, more than a sharp decline. I mean, it just plunged, and he had operating income down like 40 to 50% here. I mean, this is a company that's reeling here. And there was been some great commentary here about really the lack of innovation in terms of designs, too much heavy discounting on those products that it can't sell. So they need to do something to kind of revive this, or at least revive the cachet, I should say, that LVMH has, but for some reason Kering doesn't.
Nail in the coffin of luxury, of course, is cheaper prices.
Yeah, what are you wearing now? Is that Gucci, Prada? What is that?
I do Sergio Rossi shoes.
Oh, okay, all right. All right, stick with us. A lot more coverage coming up here on The Close. We're actually going to set you up here for another busy day tomorrow, including some big earnings out of Boeing. This is Bloomberg. All right, some big earnings today out of Tesla, Visa, and Texas Instruments, and some big earnings tomorrow morning out of Boeing. Brooke Sutherland joining us right now from our Boston bureau to talk about what to expect. And I don't know, Brooke, I mean, should we be paying attention to the numbers? Should we be paying attention to CEO succession? Should we be paying attention to all the regulatory issues?
I don't know if we're going to have enough time on this conference call to pack into all of the topics that we need to cover with Boeing. But I mean, to your point, yes, the numbers always matter. It's always important. But for this company, it's really about where do you go from here and how do you fix this? How do you fix your relationship with regulators and with the flying public? And who's going to be the one to do that? We don't yet have an update on who Boeing is going to have as their CEO. I would be surprised if we get that tomorrow. But any kind of details that they might share about the type of person that they're looking for or how they're going to navigate the path forward from here is going to be top of mind for investors listening in.
Given there's such little clarity here about that person, what do investors want to see tomorrow in terms of detail to really start to see a change in the story here?
I think it would be helpful if Boeing shared detail on how exactly they're going to address the FAA's concern. Remember, they gave them this 90-day ultimatum to come up with a plan to fix issues in their factories. And it would be good to hear just any kind of specificity of what that actually means and, you know, how Boeing proposes to clean up its manufacturing processes. We're also going to be looking for updates on where things stand with Spirit Aerosystems. Boeing has said it's in talks to reacquire that, but you know, the time is dragging on, and it would be good to understand just what exactly the state of play is in those talks. What are the hurdles? How are they going to pay for a deal? Also is a big question out there.
And just finally, real quickly, when we talk about the relationship that Boeing has had with its customers, meaning the airlines, I mean, because let's face it, it seems like they're the ones who really force what ended up happening, of course, with Lyriq. How much is that going to be brought up on the conference call?
I think it's definitely going to be talked about. I mean, you know, Boeing at the end of the day is there to deliver planes that work to its customers, and it has not been doing a very good job of that lately. And I think that is a concern, especially as you think about when Boeing moves out of this current period of crisis. What does the market share look like? It's already trailing far behind Airbus, and any further slippage there could be very detrimental to its future cash flow outlook.
All right, Brooke Sutherland helps cover Boeing for us. Boeing earnings scheduled to come out before the bell tomorrow. Team Surveillance will have full coverage of that. A few other things to keep your eye on over the next 24 hours. A rate decision out of Indonesia. And then here in the U.S., Shanali, we get a big Supreme Court hearing on abortion.
Yeah, of course, abortion is a huge hot button issue heading into the U.S. elections. And this is one of the things that will decide the fate of emergency abortions here in the United States.
Absolutely. That could have implications on the presidential race, not necessarily on markets, but here are a few things that could affect markets. And we start with some big eco data tomorrow, Shanali, including durable goods.
Yeah, and you had the softer data today. You wonder if you're going to see that continue into tomorrow, Romaine.
Yeah, we're going to get mortgage applications and a few other reads here. And of course, that's the big drumbeat as we get into the PCE and GDP numbers, which are going to come about 48 hours later. We also get some more earnings tomorrow as well.
The big thing here, isn't it? We have the Boeing, as you've been saying. You have Hilton, you have Biogen, you have Hasbro, a big swath of the American economy. Chipotle and big tech companies like IBM, ServiceNow, and of course more automakers, Ford, on the horizon as well.
Yeah, you see that. Of course, we will have wire-to-wire coverage, starting with Team Surveillance in the morning with all those earnings before the bell. Ford, IBM, and some of those coming after the bell. The close will have full coverage of that as well. Please join us tomorrow. Always appreciate you tuning in for the best coverage of earnings that you're going to get anywhere else. For all our politics coverage, stick around. Balance of Power coming up next. This is Bloomberg.